Good evening and welcome to tonight's webinar recording for the ASX Top 50 Video Market Update for May 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 22 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation, we look at the global macro update driving equities. We roll through the ASX Top 50 with a focus on FY18 and FY19 earnings. With a look at dividend forecast, we conclude with a review of our model portfolio holdings and market update. The Investor Signals model portfolio is based around an algorithm strategy that tracks momentum in the market. And if we look at the return since inception, it's been averaging around 14% per annum across the ASX 50 model. Now, the way the algorithm model works is the signals are emailed directly to our clients and they can either execute the trades themselves, or if you open a premium broking account with our firm, we will work in partnership with you to balance your portfolio in accordance with the model and overlay derivative or call options to enhance the portfolio returns at the appropriate time. A suitable way to join or inquire about becoming a client is to take up a subscription and follow the model portfolio and access the member services. We're running a special where you can access the professional level membership for $1,320. And if you'd like to know more about that, please visit Investor Signals or call our office on 1300 614 002. Moving straight into a graph of the US market. Up on screen is the Dow Jones. Now, since early January, the Dow corrected roughly 10% from peak to trough. And as we come into these March quarter earnings results, we're seeing roughly 20% earnings growth for S&P 500 companies, largely supported by tax cuts and share buyback. True underlying earnings growth for the S&P is running around 8%. So we're seeing good news, yet the market's not reacting to it. And that's really, I think, a factor of us reaching sort of peak optimism in the lead up to the tax cuts at the end of 2017. We assume for the moment that the high for this year is in for the market, and we're looking for more consolidation or sideways action, which lends itself to a strategy where you want to be selling covered calls over stocks to enhance the returns, as we're probably not likely to see the capital growth, especially in the industrial names that are already trading on stretch multiples. And the run-up in the market at the moment is largely being supported by a handful of technology companies and a strong rebound in commodities, in particular iron ore and oil prices, or metals and oil. If we have a look at the XJO, what that means for our market's actually had a stronger rebound in percentage terms, driven by the greater exposure to resources in the ASX 200. So the rebound's been from 57 up to 6100. We're almost retesting the prior high of 6150. We think that the market's getting pretty close to resistance at these levels. So when we go through the top 50 stocks, we'll look at the companies that sit inside the model and stocks that we think are good buying opportunities versus those that should be removed. So AGL's been a stock that we've liked for some time. We have the stock growing earnings at around 8 to 10% into 2019, and that places a stock on about a 5.5% dividend yield. Owning it here and selling covered calls makes sense. So just loading up the top 50, so a matter of going to the watch list, coming in here, selecting ASX 50, and then jumping back into the charts. So moving on from AGL, Aristocrat Leisure, one of the top performing stocks in the top 50 index. The stock's currently growing earnings at around 20% per annum, but trading on a fairly low dividend yield of 2%. It really is a momentum play where it's a matter of running a tight stop loss below the prior low. If we have a look at the history of the algorithm buy signals down the bottom here, which are the green markers, it's done a very good job of picking up the entry levels in Aristocrat, but it's been a while since we've had that entry alert at $20, and we'll take another look at it on the next algo buy signal. Amcor, so we like this name. The company missed earnings. It had been growing earnings at around 7-8% per annum, and that's drop down to a flat earnings forecast over the next 12 months, which has Amcor on 16 times earnings and a forward dividend yield of about 4.5%. We think fair value for Amcor for the rest of this year is probably closer to $14, maybe between $13.75 and $14.50. And should we see the stock push back up to around $14.25, we'd look to sell the $15 calls to enhance the income there on Amcor. But for longer term investors, I think Amcor represents deep value at the moment. AMP, we're still a little bit cautious on this name. They're obviously having problems with the potential class action being brought against them. And ultimately, AMP is likely to be broken up, I think, and sold off. I'm not sure that the company sort of survives in its current format post the issues that they're dealing with at the moment. ANZ, if we have a look at this, the general theme across all the banks is they continue to struggle to grow revenue. In most cases, cost control and add back of pre-provisioned bad loans has helped the banks to meet or come closer to meeting their earnings forecasts. We're seeing a little bit of a rally in some of the bank names leading into the upcoming dividends, but we think that the rally in the banks is probably more likely an opportunity to sell the rally than it is to build overweight positions. So we'd encourage clients with the banking stocks to think about selling call options to enhance the returns, or maybe using this rebound in price to change any overweight positions that you've got in the banks and reallocate that to other areas of the market. To put some numbers on ANZ, the stock trades 12 times earnings on about a 5.8% dividend yield at the moment. We think it runs into resistance again somewhere below that $29 level. APA Group, so these yield sensitive names, we're seeing a number of them create a lower high formation at the moment, and we're not doing it with APA, it's not in the model. ASX continues to be a strong performer. If we look back at the last algo buy signal down here at around $48, if we go back say 5 years ago, ASX traded on a PE multiple of around 14 times earnings. It's now trading about 25 times earnings, so it's certainly expensive by historical standards, but the justification for holding it is they're growing earnings at around 6%, which is slightly above where the market was expecting earnings to come in at, and the stock's paying about a 3.5% dividend yield, so still attractive versus bank interest. In the case of Horizon, we've been cautious on this name. We've been warning that it'll ultimately lead to a dividend cut as the company was paying out too high a dividend ratio, and with the limitations on the pricing that they have across their network at the moment, it's not a surprise that we're seeing a lower low, lower high structure. The stock was removed from the model portfolio at $5.50, and we've got a further sort of lower high formation there at around $4.60. So we're not doing anything in AZJ. Certainly be interesting when you see these type of patterns of sort of approaching oversold levels. It may be towards the middle or back half of this year we start to see AZJ create a higher high and higher low pattern, and we'll look for that to be a stock that's added into the model, but we certainly wouldn't expect that to occur at these levels. We want to see further discounting before that setup condition is triggered. BHP, we've had a terrific recovery here over the last 2.5 years. The most recent signals in BHP were around this $28 level, and with oil prices being strong at the moment and the prospect of BHP achieving a better price for the sale of their onshore assets in America, we've seen BHP push up to around $32, $33. We think this is an opportunity to either take profit or sell covered calls. Even short-dated calls into June at the $33 level are bringing in an extra 85 cents. So if you get exercise, you're delivering the stock at $33 plus the call premium. If we don't get exercise, holding on to the stock for the August dividend and resetting that call at higher levels into the back half of the year. In the case of Brambles, so we're seeing a recovery here from where Brambles 6 months ago had indicated to the market that earnings were probably down somewhere between flat to maybe 3% earnings growth. We're now starting to see a pickup in revenue growth and profit growth likely to return to around 5 to 8%. Brambles is a little expensive. I spoke about the industrial stocks trading on high PEs. We have Brambles at 19 times earnings and a 3% dividend yield. So owning it at these levels and selling fairly tight covered calls over Brambles, I think makes sense there. Commonwealth Bank, so this is a stock that sits in the model portfolio. It is trading sort of below the entry price. We've got CBA at 12.5 times earnings and a 6% dividend yield. The third quarter earnings update that just came out missed analyst expectations, and you've seen both revenue and fall and costs rise, and we're still seeing the pattern of where provisioning for bad loans being reduced, which is helping the results. Our concern with the banks is that we're probably in a inflection point where we are unlikely to see further add back of provision loans to enhance the results, and we think that could set up a bit of a dangerous picture for the banks 6 to 9 months down the track from where we are at the moment. Computershare, we think this stock's expensive, trading up at 21 times earnings on a 2.5% dividend yield. So to the extent that clients own it, you want to be selling tight covered calls against that. CSL being one of the best performers in the model portfolio. The company continues to grow earnings at above 20%. The stock's expensive at 35 times earnings on a 1.4% dividend yield, but the market's certainly chasing the positive momentum there. Caltex, we've seen a couple of analysts downgrade the valuation targets for Caltex. We think fair value is more around $32. And we've been selling the $32 calls over this name, bringing in $1.25 of income to complement the upcoming dividend. We've got Caltex on a low PE of 13 times earnings and yielding about 4% into 2019. So investors should keep an eye on this one and look for an algorithm buy signal as an entry opportunity there into Caltex. Dexus, we're not doing there at the moment. Fortescue, we continue to like this name. It's been a stock that's sat in the model portfolio for a while, and we're starting to see a recovery from $4.20 back up to around $5. There was record levels of iron ore shipped from Pilbara in the April period, which I think underlines the ongoing strength in China and demand for our commodities, in particular iron ore. So in the case of Fortescue, we have the stock on a 5.8% dividend yield into 2019. Our target's probably move back up above 5.25 to 5.50 and then look to sell covered calls. Fortescue's certainly cheap on a relative basis to BHP and Rio. Goodman, not doing there at the moment. GPT, we continue to like this as a fairly defensive property play. So owning it at these levels and selling a covered call turns sort of a 5% dividend yield, which is what it's yielding at the moment, into more like 10 to 12% on an annualized basis. We are mindful that when you look across a lot of these yield-sensitive names that we're under algorithm sell conditions at the moment. So we take that as an opportunity to be fairly aggressive with the covered call options with a view to either being exercised and delivering the stock or as a minimum enhancing the yield, given that the algorithm's flagging that they're pretty close to resistance at the moment. Insurance Australia Group being one of the better performing stocks in the model portfolio. At last had an algorithm buy signal down here at 570. The stock is looking expensive up here at 19 times earnings and a 4% dividend yield, but the downside risks seem fairly limited, so owning it here and selling a tight covered call and again turning sort of that 4% dividend yield into 10 to 12% cash flow through adding the covered call option. Intertech disappointed the market today or yesterday with earnings coming in below analyst expectations. The stock's on about a 3.5% dividend yield. We do expect this to be met with some buying interest though, so again keep an eye out for support developing somewhere between this 325 and 350 level as an opportunity to get set in Incitec. I think on a 12 to 24 month outlook, Incitec starts to look interesting again. James Hardie, expensive at 29 times earnings and a 2.8% dividend yield, so a little cautious there. Lendlease, the same here. The stock trades on an attractive dividend yield of around 3.65%, but the market's already pricing in 12% earnings growth over the next 12 months, and we're not that confident that Lendlease can deliver that. So we've got some caution that the stock maybe runs into resistance. It's filled the price gap here to around 18.50, but maybe it struggles to break through that. Mirvac, our preference to actually keep an eye on this from the short side. It was in the model and then it's been removed as a result of the sell signal. So we're just watching this carefully to see whether the stock rolls over at or near this $2.30, but certainly not one of our preferred plays. Medibank, we continue to like this. We see it's defensive, trading on 18 times earnings and a 4.2% dividend yield. Not too much in the way of revenue growth. So this is a good income stock for portfolios. We're owning it here at sort of $3 and selling covered calls at $3.10 into December. You're getting exposure to the August-September dividend as well as the added income from those call options. So again, turning a 4% yield into sort of 10 to 12% on an annualized basis. Macquarie, been a terrific performer here. The earnings results came in above analyst expectations. Macquarie grew earnings at 15% based over and above the same time last year. We have Macquarie now trading on a dividend yield of about 4.75%. National Australia Bank, we had the algorithm sell signal that was removed from the model portfolio at $30.50, now trading $28.58. So again, we would expect to see this probably move a little bit lower throughout the course of this year, but we certainly would watch with interest towards the back half of the year if we start to see algorithm buy signals appear in NAB, and also the regional banks which have been sold off significantly over the course of the last 12 months, almost by 30%. So again, no buy signal at the moment in NAB, but watching towards the back half of the year as to when that gets added back into the portfolio. Newcrest, we're reasonably bullish on gold at the moment. So whilst we recognise that Newcrest has sort of recovered this, filled this price gap, we've got the algorithm sell signal, and it may bump along sideways for a while here around this $22 level. But we think with Cadia coming back online and ultimately stronger gold prices, it should be supportive for the longer-term trend of Newcrest. Origin Energy, probably getting close to the top end of the price range and starting to look a little bit expensive at the moment. But with high energy prices, good output from the LNG assets in Queensland, we're seeing Origin reallocate that money towards paying down debt and de-gearing the balance sheet, and that'll help the company to look at reinstating dividends, possibly in August, but certainly in the February period. And we can see Origin trading on the equivalent of about a 4.5% dividend yield 12 months out from where we are at the moment. So that helps to form our view that it's probably pretty close to resistance where it's sitting at the moment, but certainly been one of the strong performers in the model portfolio. Orica, this was removed from the model, and we had a post on the blog about the short signal there at $20, and we're seeing the price roll over. So we're not doing it there at the moment. Oil Search. So we've only had two stocks added to the model portfolio this year, which have been Oil Search and Santos. Both have performed extremely well. Oil Search was added to the model around February at around sort of this 720 level approximately, and we're now seeing it trade 848. So very encouraged there by Oil Search, and we think in actual fact within the energy basket, Oil Search probably offers the most upside potential from where it is at the moment. Qantas, not doing it there at the moment. I think for clients that are holding it, it's suitable as a buy right. We think it reflects full value where it is at present. QBE Insurance, mindful that we've got a series of lower lows and lower highs here in QBE. Whether higher interest rates and maybe rationalisation of the portfolio of companies across like divisions of QBE helps to unlock some value for shareholders, but it's been a painful experience for long-term holders of QBE with the stock continuing to make lower lows and lower highs, and we don't appear to have sort of any change in that at the moment. We'd like to see QBE trade back through 1041 to really start to break that cycle of the lower lows and lower highs. Ramsay Healthcare, the stock trades 23 times earnings. We've seen the price adjust from almost $85 down to $65. Still predominantly the controlling pattern is lower lows and lower highs, but on probability we're close to support here, and we're looking for Ramsay to deliver about 8 to 9% earnings growth over the next 12 months. Rio, so one of the better performers, BHP and Rio within the commodity sector. It was added into the model portfolio at around $60 and continuing to make higher highs and higher lows. So we continue to like Rio, although recognise it as pretty close to the top end of its valuation range. South 32 was removed from the model, so we're not doing it there at present. Centre Group, a little like some of these are like GPT, I guess, where it's pushing up against the resistance level, and it's an opportunity to either sell tight covered calls or look to take profit on the trade. Stockland should grow earnings at about 5%. The stock trades on about a 6.5% forward dividend yield, and I think around this sort of 415 or 425 full, I should say, Centre Group, around 4. So let me correct that. Centre Group trades on a 5.5% dividend yield, but they're growing earnings probably something around 4%. The company's buying back about $700 million worth of shares at present, which I think helps to underwrite the downside risk to the company. Owning it here and selling a covered call over it, I think is the best strategy with Centre Group. So again, turning that sort of 5% yield into 10 to 12% through selling a covered call slightly above where the stock's trading at present. Stocklands is trading 12 times earnings on roughly a 5, or probably closer to a 6%, 6.5% dividend yield, and they're growing earnings at a slightly faster clip, probably somewhere between that 5 to 7% earnings growth. But we think that there's an opportunity here to look to take profit between this sort of 425 to maybe 440 level. We think Stocklands runs into resistance there. Sonic Healthcare was removed from the model at around $25. It's since broken down, made a lower low, rallied back, and maybe in the early stages of a lower high. We don't actually see a lot of downside risk here, though, for Sonic. We think that the stock mainly trades sideways and actually makes an okay candidate to run a buy-right strategy. At 21 times earnings and a 3.6% dividend yield, Sonic should grow earnings about 5 to 7%. So buying it here and selling a covered call, we're okay with that. Santos, as I mentioned earlier, been one of the stocks that was added into the model portfolio earlier this year at around $4.80. The stock's now up around 30% since then, but pretty close to the current bid value that's on the table of $6.50, and we haven't had that confirmed yet that that a formal offer's actually been put forward. So, and barring another competitor coming in with a higher offer, you'd have to assume that the value for Santos is between sort of $6 and $6.50. So it doesn't appear too much more on the table, and we wait to see what ends up being the final outcome of the offer that the board are currently looking at the moment. Suncorp, so probably resistance here at around $4.20 thereabouts. The risk with Suncorp is I don't think they've completely faced the music in the inquiry into the finance banks and financial services sector, and that may not really come to light until middle to later this month. But as far as the insurance side of the business goes, I think that's doing well. We have the stock about 18 times earnings and a 5.5% dividend yield, but think they're probably close to resistance, especially given the backdrop that the company where it's going to be under the spotlight later this month. Sydney Airports, terrific earnings growth, close to 10% per annum. The stock's on 5.5% dividend yield. You want to be selling covered calls at the moment, though. Same with Transurban. So I mentioned earlier that a lot of these infrastructure and utility names are under algorithm sell signals at the moment, and I think that's an opportunity to either take profit or sell covered calls. Telstra continues with its lower low and lower high pattern. Treasury Wines, a little like Aristocrat. This is a high growth company growing earnings at around 20% per annum. It trades on a very high multiple though. So Treasury, you've got trading on about 35 times earnings now on a 2% dividend yield. So certainly looking expensive. Vicinity under sell conditions, so not doing there at the moment. Westpac under sell conditions, so we'll shuffle this line up here. And I spoke earlier about with these banks where this rally is probably more an opportunity to take profit or as a minimum sell call options or maybe reduce any overweight position to these banks, as I suspect that they have greater problems that are yet to surface on the earnings side in the back half of the year. So any opportunity up here to take action is something that we'd advise. Wesfarmers, I think this is full value here. We're interested in the spin-off of Coles. We think ultimately it helps to unlock value for shareholders, but with really all the growth at the moment coming from Bunnings, and we think that's at the margin slightly under pressure. So at 5% dividend yield, Wesfarmers is full value where it is here at the moment. Westfield, they've got their vote to approve the Unibail takeover on the 24th of May. And if that goes ahead, Westfield will be delisted at the end of this month. Fair value originally for the takeover deal was around $10. We've seen a slight fall in Unibail shares since then, and it's hard to know ultimately where Westfield settles, but the shareholder vote on the 24th should maybe help to push the share price a little bit higher following that vote. Woolworths, we like this company, just getting expensive, and if we put that in context, it's 22 times earnings on a 3.2% yield on current earnings. If we allow 10% earnings growth into the next 12 months, the stock still trades 20 times earnings on a 3.5% yield. So a lot of good news is priced into Woolworths, but we are comfortable with buying it on any pullback. Maybe around this sort of $7.50 level would be a good entry level to add Woolworths, and sell tight covered calls and turn it into a 10 to 12% cash flow contributor to portfolios. Woodside under algorithm buy signal, the stock's broken out following America pulling out of the Iran accord, and our view is that probably oil prices are getting close to the resistance or the maximum of this sort of risk pricing event that's occurring at the moment. So we'd expect to see Woodside start to run into resistance at or near where it is at the moment, and there we are back at the index. So when we step back and think about is the market likely to just keep marching higher? Well, we struggle with that because we think commodities are actually getting fairly close to the top end of their resistance range at the moment. We see downward pressure on the banks, and we see the industrial sector very expensive at 20 times earnings. So we're more inclined to think that the market's getting close to running into resistance. Thank you for listening in, and I look forward to speaking again next month.